Thanks for coming and attending our talk that we have chosen to call What Loans and Tornadoes Have in Common, Challenges and Use Cases of ML in the NPL Sector. And our plan for these next 20 minutes is that I'm going to start out giving you a little bit of context around what we are doing as a business and what industry we're operating in, and give you also some terminology that you then can use to better understand what Edgar is going to talk about when he kind of deep dives into one of the use cases that we currently are working on that I find really, really cool and interesting. So to start out, we work for a company called B2Holding, and we are a leading pan-European debt specialist operating all across Europe, I would say. And what we do is that we invest in loans, and then we also manage those loans after we have bought them. So it's kind of a two-step process. About 2 years, a little bit shorter ago, we embarked on this journey to become much, much more data-driven and start to deploy analytics in our business. And we have since then built this team of really clever data engineers and data scientists. And we are working on kind of solving problems with these technologies that previously has been kind of done in legacy manners. So it's really cool challenges. And I've used the term now, non-performing loans, a few times. NPLs it could also be something that you will hear during the next 18 minutes. What is this then? Yeah, so imagine you go to the bank and you take out a loan. You are then a customer of the bank. We will then later, if you end up with us, we will call you a debtor. These terms are used interchangeably. But what can happen is that you go to the bank and you take your loan, you agree on a repayment frequency, and you pay your monthly deposits onto your loan. Suddenly something happens to you and you struggle to repay. You default on one or several of your payments. And the thing is then that banks don't really have kind of the operational structure to manage this. So what they then choose to do is that they go out to the market and they say, here we have a set of individuals, customers, debtors, that have defaulted on their loans, either recently or a while ago. And then the market, which is us and our competitors, we engage in a bidding process. So it's kind of a blind auction where we get information about these. It's typically a portfolio of individuals. Could be between a couple of hundreds to many, many thousands of corporates or personal loans. And then we get information from the banks or the lending institutes, and then we place a bid, what we think the value of this portfolio is. And it's of course less than what they have lent, because some people will never repay and some people will repay at full. But we believe that in most cases we value this higher than the bank, because we have a kind of operational system to actually manage these steps after we have purchased them, which the bank doesn't have. And then what type of use cases in our NPL industry, non-performing loan industry, for which of these use cases can we apply data science? I would say there's kind of two main areas. It is after we have bought these loans, which we also will call claims or cases later on, once again terms that we will use interchangeably. Then we need to have a very lean process. We need to know what actions to take and to which not to target anything. Sometimes you might engage in some legal process, sometimes you don't do anything, sometimes you negotiate terms and conditions. And then the other area, which we're going to focus on today, is to really, really understand the value of our assets. Firstly, really understand at what price we should buy our assets, like our bid in this bidding auction, which is typically a percentage of the face value of the debts. And of course, when we own these debts, it's quite vital to kind of manage the risk throughout the life cycle. So this is where we're going to focus today. And I just want to give a quick example on why this is so important for not only for us, but also for the entire financial industry. If only one of our competitors that engage in these blind auctions kind of misprices these assets, values them too high, it kind of disrupts the financial system a little bit, because it could start with the banks miscalculating the credit risk when they are lending, but they never kind of feel that or notice that, because there's always someone else taking that risk later on, which they can sell to. So we are kind of just the final destination for a loan in its life cycle, and it's really, really important that us as a company does well, but also us as an industry have really clever ways at measuring the risks and the value of the assets that we own. And with that, I'm going to hand over to you, Edgar.
All right. So before I start, just to mention that we are hiring data engineers in order to scale all of our process. But let me try to explain what Lukas mentioned about the valuation. What you can see in the image of the left is what we call the claim or the case level estimates for an individual cash flow. That is like an accumulated fraction over the face value. So it's the payments that a debtor does over time divided by the original size of the debt. And you can see this cumulative plot. So what we want our models to do for this valuation use case is to be able to produce accurate case level predictions in order to be able to produce accurate portfolio level estimates. One could think that if at the end of the day what we want to do is to predict at portfolio level, why we don't build a portfolio model, why we don't use some aggregated characteristics of the model in order to be able to predict the portfolio. Because we are a team that is working at group level, we need to make the solution as generic as possible. And the problem that we are having is that we have some countries that they have more than 5,000 portfolios, but we have actually some countries that they have less than 50. So with 50 samples, it's very difficult to build a model. But when we look to the number of claims, independently of the country, we have around 100K at minimum. So that's why we decided to go for the case level models. Before I move on to how we build this solution, I just want to give you just two fundamentals about regression. The first one is that when we are trying to build a regression model to estimate this repayment amount, we can do it using a feature target relationship that it can be different for every case. It can be different for every debtor, for every product, etc., etc. For instance, every claim has a certain size. It has a certain age, and so on and so on. And the debtors, they have characteristics like the age, where they live, etc., etc. And we can have that these features, they can be static forever, or they can be actually varying with time. We can also use some autoregressive features, and this is actually quite common in regression. But for the purpose of this use case, we cannot use these autoregressive variables. And I will make a very simple example. Even that sometimes the banks or the vendors, they offer us the historical payments, that you could consider that this is actually the historical cash flow that the claim has been, let's say, getting. This is not the same cash flow that we have in our system, because that was the historical payments when the bank or the other financial institution had the claim, not when it came to us. So when it came to us, we had some payment plans, some discounts, some calls, some negotiations with the customers, and then we will be modeling, a variable that in reality it is not. So yes, we can use autoregressive variables in the most time series fashion way, but only when that debt comes into our system. And of course, we have some latent variables that they are not directly observable in the data set, but they are there because we have macroeconomics, interest rates going up, COVID, etc., etc. So you can combine all of this in order to build a regression model, and you can actually build the regression model in different ways. At the end, we want to predict the performance of the portfolio 48 months ahead before we purchase it. And what we could do is we can build a model in order to train a model for all of the cash flows, the 48 cash flows. But if we do that, all of the features, they need to be the same for that model, a priori. We can have a direct prediction strategy where we build one regression model per actually target that we want to predict, and we can vary the features. Or we can do what we call the Chainnet approach. That is, yes, we can vary the features, but we are also recycling the prediction of the previous model into the next one. Of course, as a data scientist, we have machine learning engineer friends, so we don't want to build 48 models. And what we wanted is to build a native model to be able to predict all of the cash flows at the same time. Well, not that fast, because the problem that we have with this multi-output approach is that not all of the claims, they have the same age. So if we would like to actually build a multi-input output model, we will have to use claims that they are older than 2019. And I think that pretty much everyone here knows what happened in 2020 and 2021. So I think that this had some underlying economical impact in our data. So at the end of the day, we made the life of our machine learning engineer miserable, and we end up with 48 models. But we managed, so it's no problem. Another problem with this multi-output approach is that the cash flow distribution or target distribution varies a lot with time. And we actually only have this time variable, the month, to capture this variation. And one of the challenges that we saw here is that the behavior of the cash flow in the first month after collection is very different from the behavior of the cash flow after, for instance, 48 months. Because at the end of the day, if the loan defaulted, it was probably because at that time that person or company, they didn't have any money. But of course, situation improves. We are there to help them, to call them, to offer payment plans, discount, etc., better interest rates. And then we see that this distribution is shifted a lot. So, OK, this is very interesting, but I'm pretty sure that you are here because of the tornadoes. So what the tornadoes and the NPL loans they have in common? A couple of months ago, when I started to work in this use case, I found a paper where some investigators, they tried to estimate the damage that tornadoes can do. And what they found is that this damage was heavily zero inflated. What do I mean? That a lot of tornadoes, they don't do any damage. There are some tornadoes that they do damage in a, let's say, normal distribution way. And of course, certain tornadoes that they do a lot of damage. So we have a long tail there. So if we look to the distribution of one of our cash flow, in concretely the first month, you can see that most of the values, they are zero, and we have a small fraction of payers. And if you have read the classical article about, how to deal with your skew data, you can do a log transform. Spoiler, it doesn't work. So you still have a very skewed data set. And when looking actually to the distribution of payers, you could see that this follows more or less a normal distribution. Of course, we have a peak in the people that they are paying a bit more because of the interest. But if we compare it with the tornadoes distribution, it was actually fairly close whenever we zoom it in these payers. OK, so how we deal it with this zero-inflated data? I could talk about this slide for 2 hours, so I would not do that. And I just would like to say that there are many methods in order to deal with this data. Some of them, they are very old. Some of them, they are more new. Some of them, they come from the insurance world, because with the claims, they need to do something similar. But today, we are going to focus in what I call the Hurdle models, or the two-part models, and the 2D models. About the Hurdle models, just to say that basically it's a two-part model. So you have one part of the model that estimates the probability of the claim or the case or the cash flow to be zero. And then another part of the model that in case that is not zero, it will estimate how much the customer is going to repay. And for the 2D regression, or for the 2D distribution, this is basically a mixed distribution that unfortunately doesn't have what we call closed form for estimation. So you need to approximate it. And this 2D distribution has one scale parameter that, depending on the value, it will be more similar to a Poisson distribution, or it will be more similar to a gamma distribution. So how you can generalize this a bit more? If we have this Hurdle model, this two-part model, your classifier and your regressor can be pretty much whatever you want, depending on your explainability needs, if you want a simple model, etc., etc. And what we did is to introduce what we call ZIPX and ZAPX. This is coming from some Spanish cartoons that they were pretty famous. They were, by the way, very politically incorrect, but don't worry, the models, they are very good, so you don't need to worry about this. And XGBoost, since a couple of years ago, I think, it supports these 2D laws. the only thing that you need to tweak is this 2D variance power that is exactly related with the previous shape that I mentioned 2 slides ago. So, OK, what is the benchmark case? How we are measuring the performance of the model? So we did the following experiment. First, we tried it with a 2-part model, and we assumed that the classifier was going to be perfect. So the classifier will not make any mistake, and we will train the regressor only with positive samples, only with people that they are paying. In the second experiment, we assumed that the classifier was imperfect, and therefore, we were injecting some zero noise, that it was actually in similar proportion to the false positives. And then in the third benchmark, we disregard the classifier. We went just with the 2D model, and let's see what we got. So what we got is that the best method of all of them was this imperfect classifier. And I know that this is a bit hard to see, but in the top left corner, you can see how the model is predicting around 30,000 zeros. Meanwhile, the 2D one, that is the one in the right, is predicting around 20,000. So it's missing the fraction of zeros quite a lot. And if you see to the distribution, you can see how the 2D has some sort of decay in the predictor distribution. Meanwhile, the classifiers, either with zero noise or not, they are following the distribution much better. And in terms of error, if we compare the 2D with the classifier with zero noise, we are able to reduce the error by 0.5%. So how we scaled this, because of course we have a lot of models. We used Azure machine learning pipelines. We parameterized all of the pipelines. We put all of the models in the model registry, and we had a lot of more infrastructure components here, CI/CD pipelines to build these models, to deploy the machine learning endpoints into production, ADF to trigger these machine learning pipelines, Azure functions to post-process the results and write back to the database, etc., etc. But probably it's more important what is the output for our business users. So we built a Power BI dashboard, or BI team built a Power BI dashboard where they can visualize the predictions of our portfolio estimates versus the actual ones, and also versus the current, let's say, standard model that we are using in-house. And for us, as data scientists, we are basically logging pretty much everything. If someone is using Azure, I'm very sure that he will find very funny that we are logging the histogram, because it's not easy to do this in Azure. I don't know why. But basically, we are logging different performance metrics, intermediate CSV files, a lot of explainability plots, mainly supply values, and more important, partial dependency plots to see if the models they are learning the feature dependency correctly. And pretty much, this is what we did in just a couple of months. What I have told you is just chapter 1. So how we have scaled this to different countries in the group, how we are aggregating confidence intervals at portfolio estimates, or how we are generating confidence intervals for ZIPX models that they use the 2D distribution, is something that maybe some of my colleagues, they will tell here next year or in other conference. And if you were interested about chapter 1 and you want to help us to write chapter 2, we are hiring. Thank you, and we are open for questions.